Good Monday morning. Sorry I'm late, Dimitri. Welcome all chameleons and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. I need to share the disclaimer.
Good morning, everyone.
There it is, D. You want to start with it?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance.
Excellent.
Yep. And I'm going to share my screen.
That's the start of the webinar on Zoom.
Okay. While sharing my screen, everyone who may be joining us for the first time today, Will and I, we do this show in the morning to help answer any questions you may have about the Market Chameleon data, tools, or analytics. If you want to come on a show and ask your question live, we provide a link to Zoom. When you click on it, it takes you to Zoom. There's a button, raise your hand, click on that. Once we let you in, you could ask your question directly. If you prefer to type your question into the live chat, you can do that. Will's watching and he'll read it back to me. While we're waiting for more people to join us and for questions to come in, we'll start out taking a look at the pre-market report to see if we could get some insights, what's going on in the pre-market hours. Then Will, if questions come in, let me know. I'll take those questions. If we don't get any questions, I'll navigate to a different part of the website, see if we could get some insights from some different tools.
Perfect.
All right. Pre-market trading. These are stocks that are trading in a pre-market hours. If we scroll down here, we have a list of our most active stocks, a list of our biggest percentage gainers, biggest percentage decliners. Down here, I see 124 stocks on our percentage gainers list, 36 on the decliners. And from this perspective, it looks like we're lining up for a bullish bias at the open. If you guys look closely at the list, you will see that there are small cap stocks in there, ETFs, leverage products. Pretty much any security that's listed on a major U.S. exchange, if it's trading in pre-market hours and meets our thresholds, can make this list. So what we can do is start narrowing down this list to a smaller group of stocks. And we'll use the filters here above to do that. That's what these filters help us do. I'm going to use this one, an ETF. Click on it. You get a drop-down menu of ETFs to select from. We have some broad-based ETFs in there, some sector ETFs. The first one, SPY, that's the S&P 500 ETF. Let's click on that. And the list below will get filtered by stocks that are holdings in SPY. So here we got 31 stocks on our percentage gainers list, 3 on the decliners. So from this perspective, right now we're looking like we're setting up for a bullish bias at the open. I think maybe a couple things worth mentioning right now is that what we're seeing with the AI, with some of the chat GPT and some of the excitement on AI, is that there is a lot of investments now going into different ventures that are going to utilize this technology. And we don't know all the tools that are going to be created and will be successful, but this type of excitement kind of reminds me of the beginning of the internet boom, where the technology itself is seen as disruptive to the entire economy, right? To almost all industries across the board. And we're really just at the very beginning of seeing that, yes, this technology works. It's really good. And I think that the application of it will be incredible. And And some of that now is starting to also spill over into the market, right? But definitely, if you guys pay attention to these, private equity, venture capitalist firms, the way they're throwing money at ideas right now, and engineers and people who are involved in it, is pretty incredible. And stocks or companies with almost no business plan, no revenue, they're based startups, it's concepts, are getting very high valuations. Sometimes, from 10 million, from valuations in the tens of millions to hundreds of millions, in valuation, that haven't even yet created the product. It's just a concept.
Which is amazing, because AI isn't new, right? It's been exposed to the public for the first time in this ChatGPT, which is a super high-end search engine. But Google, Palantir, Facebook, they've all been doing AI research and using AI within their platforms for a long time, right? They all have staffs, whole departments working on it. So they're probably
good public
investments to make if you want to play AI already.
Now they're democratizing it. They're saying, let's make these tools and technology available, sometimes open source or available to the general public. And they're showing us use cases there. And once they kind of unleashed it, now people are using it, right? People have, with different use cases, different imaginations are coming up with.
It's amazing.
Ideas.
Like, you think about Microsoft, right? It looks like they're at the forefront because they provide the back end, the servers that are needed to do all this work, right? And so all these little companies start up, they're going to need their servers, they're going to use ChatGPT to do whatever. The API source code, and it's, they're like what's the old for the picks and shovels, the business.
Who's providing the picks and shovels. And I think that also the technology, even though I think that the concept of the AR and the math and maybe the algorithm existed prior to the technology that is required to run these things, because they're very intensive, right? I could imagine, because we do a lot of queries on data, and it takes up a lot of processing, a lot of storage. You're always managing the data, trying to make it more efficient and building libraries and blah, 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 right? And the technology to be, able to catch up to the ability for you even be able to use this new technology, that's what I think is also imperative. And they're talking about investing in chips. You're going to have to invest in more data storage, and these models, I think, are pretty intensive to run. If you're training a model, if you're going to sit there and train a model on data, you're going to be using a lot of resources. It's not going to be free, right? It's not free to do that. And we don't know yet even what the business model will look like for these AIs, right? Somebody has to pay for it. So there has to be a way for, companies that are creating these tools to generate revenue, right? So either you're charging directly or somebody else is paying or something, a model has to exist that works and can fund these applications. So
we did have a question from Steve.
Yeah.
He was asking, maybe we can take a look at, I guess, maybe it's TTD. I think that's Trade Desk, for upcoming earnings. See if you see anything interesting in the earnings.
This one. Okay. Does he have anything specific he's looking at the earnings? So May 10th. earnings are coming up. Ask him if he's looking at anything specific.
Well, you heard it, Steve. Are you looking for anything specific? I do see while I'm looking over your shoulder at the screen. There was oh, you moved from TTD.
So this is TTD, right? And we could take a look at the interactive charts. So just beginning with this summary page, while we're waiting for a follow-up question. This is some of the historical stats comparing the implied moves, which are the moves that are predicted by the market. And when we're talking about moves, we're talking about the magnitude of the move up or down, which is implied by the option straddle. So on average, historically, that's the implied moves were 13.2%. So if you click on that, it'll take us over. This is the chart of what the options were anticipating the move prior to the actual move, right? So that's if you wanted to bet on the move, using the options, this is where the straddle was priced. And we could go here and see this was priced as high as 24%. So I think that's it right here, May 22nd. And it has a wide range as low as 7.6%. The median is 12.3. And we could narrow down this data by looking just maybe, let me see, what's the next quarter. So they're coming up with Q1 earnings. So let's look at Q1. Click on that. So you can see Q1 the stats seem very similar. Maybe the median returns a little bit below that. Historically, we could see that in Q1, using this filter, that the options underestimated the move 66% of the time, meaning that the actual move, if we measured it from the close of business day prior to the move to the close of business day after earnings were released, the actual move exceeded what the options were pricing in. All right. And I believe right here we're putting in currently the options I think are pricing in 13%. We still have some days to go though. It's the announcement's expected May 10th after the market close. Here you could also just get the percentile of, here, let me see. Here's a graph of the last 12. This is a graph of the last 12 predicted moves, this bar up and down versus the actual. So you could see here, last time around, options were pricing in a 13.8% move. The stock moved 32%, up 32%. And it looks to me, that the actual moves could be pretty big, and a lot of them were to the upside. Right?
Yeah,
so
Steve actually said he followed up. Basically, I'm wondering about the value picture of the company. I guess he's looking at the fundamentals, but he says, I have a low cost basis and considering a hedge against a down move, but it always seems to beat on earnings, which would obviously mean a lot of times the stock goes up, which you're seeing in the picture.
Right. And we could take a look at the actual earnings moves over here. So if we took all these earnings moves from, going back to 2017, right, May 2017, it looks like 67% of the time the stock was up on earnings, right? And these are the simple averages. So we had on average it was a positive 10.7%. The average move was up or down 16.5%. But what the average means is basically if every single time you just bet the same notional amount on the earnings, right? Like say $1,000 worth of stock, and there'll be losses. Obviously, there are losses there, ups and downs. We could see them here, but on average per move, it would have been profitable 10.7%. Okay, 10.7% per earnings. But you could see how wide the distribution of returns here. It was up as much as 43%, down as much as 26%, and the median moved 4.7. So this is looking at the simple returns. This is looking at the absolute returns, which is up or down. Okay. If you wanted to just take a look at, a particular move, let's just say, how often does it move more than 10% out of all this data that we have till 2017? You put in a calculator, we calculate that. So 46% of the time it moved below 10%, meaning 54% of the time that move exceeded 10%. So that's how to use the calculator there.
Someone was asking about, there's I guess in the upper right-hand corner, there's an option. It says option strategies detected. Could you walk through that?
Yeah, what are they asking specific? Can you read?
They said there's something that says alert in the right-hand corner. It says option strategies detected earnings.
Okay. This one over here?
Yeah.
Well, okay. So what this will do is scan historically for option strategies and filter out the ones that had the best performance. Okay, so this is looking from a historical standpoint and looking at option strategies that had the best performance over time, and then it filters it out and displays it here. The default is the option strategies with the defined risk. So here, two of them were listed where it had they were both a credit put spread. Okay, and the credit put spread, the top one was the 25 delta, selling the 25 delta put, buying the 15 delta put. Okay, so it's a out of the money credit put spread, selling the 25 delta, buying the 15 delta put, and the period was 3 days prior to earnings and holding it to 1 day after. So obviously there were a lot of more up days than down. So this is partly why this has been profitable. And keep in mind, that's what happened historically. We don't know what's going to happen in the future. We're just taking a look at it from its historical patterns and tendencies. And if you wanted to look at the actual observations, you could click on here on this 11, and this will give the data. These are the historical earnings. Okay, this is looking at the put that from the short side, the 25 delta put, the 44 strike. This is looking at the long put. It would have been the 41 strike. Okay, this is what the option was prior, before the earnings. This was after. So if we just took this one, for example, right? And if you wanted to see the options chains, you could click on there and it drills down and shows you the snapshot option chains before and after. But let's close that. So what this is saying is, this is where the put was on the 3 days, right? 3 days before earnings. It was 138, 144. And the put that you're buying was 68.72. 68 cents to 72. So it's marking it at midpoint. So if you sold that, right, let's say at 141, bought this at 70 cents, you could see that after you would get credit, right? So that would be in the credit. What, 71 cents, I think. And after it reported earnings, both of these options went to zero, basically. So the stock, this is what the stock did, right? The stock went from 48.73. So you're selling the 44 put, buying the 41 with the stock at 48.73. The stock was up 30% when 63.11. So both these puts, you could see, went to zero. The stock, they were way out of the money. So that would have been a 71-cent profit. Okay. And the return on that was 31%, which is basically the return on the money at risk. So you could go back and see how the stock performed during this date range. These are the stock performance. And then you could see how this corresponding strategy performed with the stock price on these dates. So even with the stock here, let's take this one down 8.3%. So this was looking at the moment, selling the 43 put, which would have been the 25 delta put, buying the 40 put, which would have been the 15 delta put. So prior to the event, this is where the market was, 191.2. This put was 117.23. The stock went from 48.97 down to 44.89. Okay, so it did go down. It did go down. You're selling out of the money put spread. So you are bullish delta. It did go down. Of course, implied vols also came in. So you could see it didn't go quite to zero. This came in from 191 to 60 something cents. This one went from 117 to 11 cents here. So there was if you're selling it, that spread came in by 26 cents, which still resulted in a profit. All right. So this is the supporting data for this particular strategy. And again, it's only looking from a historical perspective to find things, that perform the best to start taking a look at. Okay, that's what this time around it could be different. So it's up to you to continue to do that research. That is it's just starting points for ideas. Let me close this, come back. So the defined risk would have been like spreads, right? So the reason they're defined is because if you're selling something and then buying something, then if this thing collapsed, you are stopped out because you are buying an option below.
Hey, D?
Yeah.
We only have a couple minutes left, but Steve is asking another question. He wants to see how he can look at he wants to buy a put like 58 or 59 strike around there, and then sell a 25 delta put against it. Could you show him how you can walk through it and maybe analyze it using the options chain and bringing it up?
All right, so I'm going to go to the options chain. Just walk me through what he wants to look at.
All right, so I guess
what is the expiration? May 12th?
Yeah.
All right, so I'm on May 12th expiration.
So we'd be looking at the like the 58, let's say 58 delta put or 58 strike put, buying that. And then he wants to go
58 strike put.
Yeah.
Okay.
And then he wants to sell the something close to the 25 delta, so maybe the 56 against it.
So he wants to buy put spread?
Yeah.
Okay. And what is his question? So here's the put spread. So you're looking at a put spread 65 cents, right? With the midpoint 58 cents. This is your payout. So if the stock tanks, your sweet spot is right there below this strike 56. At that point, you're making $135 versus 65-cent risk. Of course, if it goes up, then you're losing this amount. We could plot what the stock tended to do. So here's the last 12 moves.
We've already kind of looked at that, right? It's so up, seems
It's
up.
been up, right?
Yeah.
So it's been up from that. If you just want to look at here's the last earnings. So it's up here. Of course, it could go down that much too. If it could go up that much, it could go down that much. Let me see. So this is the last 12 moves. If we just took the average, 14% here, 14%. So if we just took what the average move is, right? If it does it to the downside, it will cover that, right? So it would pay off on this, because a 14% move would be below this 56 strike. So you're doing a $2 put spread with the idea that the stock will be down after earnings, and your payoff, you could see here. Well, all right, so I think we lost Will. I'm not sure if there's a follow-up question. So at this point, you may just stop right there. If there is a follow-up question, we'll take it. We'll come back to it tomorrow. Just put it in that chat. We'll try to save it and come back to it. And just a reminder, everyone, real quick, tomorrow we are doing a webinar with Interactive Brokers. It's going to be covering implied volatility versus realized volatility. That's going to be at 2 o'clock tomorrow. And you do need to register with Interactive Brokers because they're hosting it. It's not going to be live on YouTube. And so register with that. They'll give you a reminder. If you register and miss it, I think you could still go see the replay. So I'll end it right there, everyone. I think we lost Will. So everyone, have a good day. Have a, stay safe out there. Have a great trading day, and hope to see you guys tomorrow. Bye.